Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The New York exchanges had their best month of the year. Ross takes a look at why they popped higher. However, it's still a struggle for the miners. Ross also has a special offer for our listeners. Toronto-based economic analyst Ian Prittie warns Canada's real estate bubble is about to burst, taking the economy with it. His numbers might shock you. WolfStreet.com's Wolf Richter tells us whether he believes the U.S. is now in recession. He weighs in on inflation, interest rates, retail, and auto sales. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, was this the shiniest, prettiest stock market we've seen all summer?
Oh, not just this summer, but I mean, you got to go back to 2020. I think this is the best month that we've had in quite a while. And, it comes off a really, hard oversold condition into June. We got some, everybody gets so caught up in the short term. But when you look at the longer term charts, the monthly chart on the S&P or the Russell 2000 or the Dow, they just tested their 50-month moving averages. We got nice oversold conditions into those May-June lows and some good basing action. So you got this oversold, a nice tested low, and if you look at these indices, it's a pretty good-looking base in here. And you would expect to get at least a Fibonacci 38% retracement rally. And I wouldn't be at all surprised that you see better than that taking us through August. And we'll look for maybe a topping formation as we get into maybe the next 4 to 5 weeks. Things might get a little ahead of themselves up here. But for now, there was good support on the break and on the turn here. So, participate in the move and looked for, staying with the sectors that are not so much the ones that are oversold the most, but the ones that have been most resilient, that have held up on these moving averages. Things like the oil and gas. You take a look at those indices, the XEG or the XLE. They are still in dominant uptrends, and if you look at some of the names that like a Buffett would be looking at, a Chevron or a Suncor, good strength still showing up there. We've had a decent pause, and we're just about ready to hit into the seasonals as far as the energy is concerned. Look for some strength there, maybe to take us right into October. So could be pretty interesting group there. And as I say, it's already doing reasonably well, maybe ready to pick up a bit of steam. The other item from a seasonal perspective would be the healthcare index, the XLV from here into October, a good time window to look at. So I would definitely put that on the watch list right now.
The U.S. dollar continues on a charge. Every other currency around the planet just about appears to be melting under its influence. How's the Canadian dollar held up?
Canadian, has been reasonably buoyant here in this last couple of weeks, and just grinding up. no big action there, but not the sell-offs that we're seeing in some of these other currencies out there. The real action, when you think about what's going on currency-wise, it was to just take a twist and look at the gold market. A week ago, the CFTC, the Commodity Futures Trading Commission, the data that came out of that showed that the speculative long positions and the commercial short positions were at extremes that we've only seen 5 times in the last 10 or, well, actually it's 20 years when I look at my charts here. And so what you ended up with is so much money that it was now negative as far as the gold market was concerned. We had that sell-off from the high in the spring down into just 3-4 weeks ago. And the negative sentiment out there was enough to take the indicators that we look at, the relative strength index and the Bollinger Bands, and they were outside of their normal parameters. And as of last week and this week, they're now turning back in. So that change in attitude is causing what should be a fairly good move as far as gold is concerned. We're up $80 on the week this week. And the typical action off of one of these reversals would be a multi-week rally. So I'm thinking that maybe the whole month of August could have reasonably good bias to it over there. The thing that would be the fly in the ointment right here, and the thing is not working, is the fact that the miners are really underperforming what we're seeing in the bullion, both in the gold and silver. So unless the miners can really pick up in here during August, wouldn't be looking for this rally to take us too much farther, as you say, than through the month of August.
Ross, thank you so much for the update.
Always a pleasure to be with you, Jim. And for the next week, we're still offering 25% off on annual subscriptions for new subscribers.
We've been speaking with Ross Clark from chartsandmarkets.com. Check him out on Twitter at ChartsByRoss. Coming up, Ian Prittie, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Ian Prittie. He's an economic analyst in Toronto. You can follow him on Twitter at the Reds8. That's the Reds, R-E-D-S, and the number 8. Ian, it's been a long time. Welcome back to This Week in Money.
Great to be back.
Let's jump in with Canada's real estate bubble with rising interest rates. Now, the last time interest rates took off like this was in the early 80s, but we didn't have massive debt bubbles back then. How bad could this real estate bust get? And in theory, how far could prices fall?
Well, I think it is very similar to that period, and you're absolutely right. It's the extra debt that exists in the private and public sector today will make things far, far worse. I think it's a 40-year credit cycle that is ending. And I predicted that in Toronto, before all this started, that the median price of housing would fall 50% guaranteed, and 75 to 80% is much more likely. So I think for the reason that central banks are still not serious about dealing with inflation and are probably somewhere between 7 and 10 percentage points behind on central rates. And yesterday we had the U.S. Federal Reserve completely chicken out. They should have done 100 points or more, since they don't meet again until September. So they're running a very high risk now that they will need to raise rates intermeeting, which would be a big shock to the markets.
How believable is the Fed? A year ago, they said this inflation was transitory. Can you believe anything they say?
Well, it's ridiculous. I mean, they've done cheap money for, I think it goes back to 1998. I mean, the beginning of it is arguable, but it's at least 20 years. I would say more realistically 24 years. And they've conditioned the market to always expect that when they run into some headwinds, they'll just take rates back to zero and continue the game. But they're stuck now because the thing that makes this period different is the raging inflation and the excess money supply, and they're going to have to sort that out. And I think they've lost all credibility.
How long could it take for real estate markets to bottom?
I think this period will be very similar to the U.S. experience in 06 to 08. I mean, the last bear market we had in Toronto was 89 to 96, so it was a very drawn-out 7 years. Median price lost about a third of its value. I don't think that's what's going to happen. I think with housing prices going parabolic at the beginning of the year, I think it's going to be quite an implosion. So I would say that probably that scenario that played out in the U.S. would probably be the closest bet. So something like 2 years of really significant decline would be probably the best case.
How high could interest rates go, and how long would that take to get to their peak?
Well, I think a good reference point for that is to look historically at what interest rates have needed to be at in order to deal with the current level of inflation in the past. So 1990 is a good example. Inflation was about 6% in Canada, and at that time the overhead rate was around 14%. So if you equate those and say that it's the same sort of scenario, then 14% is probably the most likely case. And I think the problem these days is far worse than that time 30 or so years ago, because as I was saying earlier, I think central banks are dealing with about a 24-year buildup of cheap money and excess money supply. So I think the central banking system around the world will have a much more difficult time getting this under control. And I think double-digit central rates are almost a certainty.
The U.S. government says inflation is close to 10%, in Canada close to 9%, but what do you think is the real rate of inflation?
Well, government has a major interest in underreporting inflation to make themselves look better, and it's something that's been studied for a long time. There's a lot of very revealing information that kind of exposes that, and the real rate I think is at least double what's being reported. There was a tweet this week from Dave Cullum, who's a professor at Cornell, showing that he's calculating inflation at 41% year over year for average everyday items like groceries that really affect the average person's pocketbook. So there's a reason the government likes to exclude food and energy from its inflation calculations, because that's what really hurts the average person. So I think it's much higher than they're reporting.
Historically, how does inflation end?
Well, the experience of Paul Volcker in the early 80s as Federal Reserve Chairman shows that there's no way out without seriously restricting money supply. That's really what has to happen. So there have to be rapid and very serious central rate rises in a very short time period. In that case, I mean, it's really about 1 to 2 years to really get inflation under control. So it takes drastic action. And I think the scenario we're living in today is Volcker 2.0, as I'm calling it, and it's all happening again. And I think the bond market is completely out to lunch. It has no clue what's going on, and yields should be much, much higher.
Ian, what's happening to consumer confidence?
Well, the most interesting data point of this past week was actually consumer confidence in China, and it fell something like 40 points. It went from 125 to 85. I've never seen anything like that in a consumer confidence index. And the same scenario is underway in North America. And people are not comfortable spending when their mortgage payments and cost of living are exploding. So I think it's fair to say in the next 6 to 12 months we'll see major declines in the consumer confidence indexes in North America for sure.
Is Canada in for a housing and economic collapse?
I think it's a certainty. I set the odds at 100%. And the reason is there's such a buildup of public and private sector debt that the current system just won't survive major rate increases, which I still think are going to happen anyway. So in Ontario, as an example, the Fraser Institute looked at the historic participation of the construction sector as part of the overall GDP, and in a long run scenario, it's usually in the high single digits, so like 8 to 9% is what it's historically been and probably supposed to be as part of the economic output. But because of all the bubble that's gone on and all the crazy speculation, it's been running in the double digits and like high double digits at some point. So that's absolutely not sustainable. So it's probably about double where it should be. And of course the jobs associated with that, so the tradespeople and other jobs in construction, anything revolving around real estate and construction, I think is very vulnerable.
I'm seeing some tweets saying the Canadian government is already thinking about bailing out people who invested in real estate. Should they?
Well, absolutely not. I mean, that's the kind of distortion that makes markets not work. There can't be that moral hazard where, if it's heads, your speculation wins, and if it's tails, the government solves all your problems. And there's been a long history of that, of central banks doing that, the TARP funding back in the global financial crisis, and long-term capital management before that. There's no way that governments and central banks should create that scenario, and the risk of market participants has to be absorbed by the people taking that risk in the first place.
Could the massive spending by governments, including significant subsidies to people, be by design to bankrupt Canada?
I think there's a good chance of that. I think it's likely because when you get past the conspiracy stuff and you simply look objectively at what's happening, it's very clear to me that there's an effort to create maximum boom and bust. And I think there's a lot of evidence to support that. So the most recent example would be central banks not raising rates starting in 2021. They knew the worldwide economic recovery from COVID was well underway. Of course, the economies around the world had been in lockdown. People were at home. Businesses were closed. They knew that a recovery was taking shape, and they had an opportunity to raise rates in 2021 to take this rate rising path more slowly in a more measured way to do it more responsibly. And I think by waiting so long to create, in particular in Canada, the housing bubble that we had going into February at the beginning of this year, to not raise rates earlier has created a far bigger problem than they already have. And so another brief example was the removal of the gold standard in the early 70s. I think that was really the catalyst that set up all the subsequent boom and bust that we've seen basically over the last 50 years.
Could Canadian banks be in trouble?
I think there's a very good chance because they have a combined mortgage book of $1.5 trillion. That data lags a little bit, so it's probably when we get the final number for February, it probably is higher than that, maybe 1.7 trillion or so. So that's a lot of exposure, and if defaults start happening and people start walking away from their homes, I think there's a very good chance that the banks will become unstable. And the first thing the government will think about is a bailout, but the problem is that the public finances have been so devastated with all the deficit spending during COVID that there is no more money to print. And the market, I don't think the bond market will accept that. So something truly awful is coming. I don't know exactly what shape it's going to take, but it's definitely scary.
Should Canadians be worried the banks will do the so-called Cyprus haircut and dip into your bank account to balance their books?
Well, yeah, I mean, that I know that, I don't recall the year, it was sometime after Trudeau won in 2015 that they adopted that standard that had been done in Europe where the preferred shareholders of a bank, basically those deposits, if you can call it that, would be used to help stabilize the bank. And so a couple people talked about it at the time. It's, of course, not been really topical because the banks have looked like they're stable ever since, but that kind of action that government has taken and potentially could take will definitely come into focus if failing mortgages start to really stress the banking system. So it's definitely a concern.
Is the Philadelphia Fed Manufacturing Index an important indicator, and what exactly is that?
I think it's extremely important. I'm biased because I have a family background in manufacturing, but I think it's still a very relevant sector despite government's best efforts to destroy jobs in manufacturing. And the Philly, as an example, in the last week, the Philly Fed Index of New Orders plunged to a record low. So since the data from 1985, it wasn't even this low in the global financial crisis in 06 to 08. So that's a very ominous sign. And again, would point to just large capital equipment not being bought, and that will lead to a lot of job loss as well if it continues for any length of time.
The stock markets dropped substantially in the first half of this year. Could the stock markets now be looking to climb a wall of worry?
Well, there will always be counter-trend rallies that will fake people out and make them think that the good times are back and there's nothing to worry about anymore. But I do expect a bear market in general all year, and that goes back to the fact that I don't think the central banks are anywhere close to finishing their rate rises. So you had this short euphoria yesterday with the Federal Reserve only raising 75 points, but I doubt that enthusiasm will last long. Once the equity market realizes that rates have a long way to climb, I think stocks will be in big trouble, and especially technology stocks, which have had an incredibly weak first half of the year.
What are your thoughts on the Russia-Ukraine conflict?
Well, the official story that's been told to the public is absolute nonsense. Ukraine had democracy until 2014 when the industrial war machine began to get uncomfortable that President Yankovic was making peace with Russia, which was threatening their profits. So Obama, the CIA, proceeded to overthrow that government and install a puppet government, which then proceeded to bomb the eastern regions of ethnic Russians. And Russia has clearly had enough and is ending this war, not beginning it. And all the people with the Ukraine flags on their car need to have their heads examined. Like, they simply have no clue. And thankfully, we have great independent reporters like Canadian Eva Karine Bartlett, who are on the ground in the eastern regions covering all the destruction that Ukraine and the globalists have caused. And people need to watch and read her material so they can understand that they're being lied to by the corporate media and our government.
Agenda 2030, the Great Reset, is being implemented by World Economic Forum young global leaders that have somehow managed to get into positions of power across the world and here in Canada, federally, provincially, and in major cities. Does this help to explain why and where we are today?
Absolutely. It's exactly what the U.S. historian Carol Quigley said about the illusion of choice in politics. If you vote for a traditional party, you get Agenda 2030. They do a great job of pretending that you have a choice, but if you vote for a traditional party in Canada at any level, you're getting the agenda. So lately, we've had Pierre Poilievre claiming that he doesn't know what the Sustainable Development Goals are, so that's all the proof that anyone needs. And until we get rid of the Sustainable Development Goals, there won't be any peace for anyone in Canada.
Experimental injections that are in human trials until 2023 have been pushed on the people of Canada. Could this human experiment have repercussions for the people of the country and the Canadian economy?
Unfortunately, it looks that way. People were rushed into a decision that was specifically done in a panic to prevent people from pausing and thinking and asking basic questions. We have no idea what the effects will be long term, which is terrifying, because the short-term adverse events and deaths are already deeply concerning. So you have life insurers in the States like Lincoln Financial who are already reporting very unusual death statistics. So the long-term prognosis isn't good. And that obviously will seriously make what I think is already a dire economic problem far worse.
What do you make of monkeypox?
Well, there was a former World Health Organization insider recently, I think in the last 2 or 3 weeks, who said that fake pandemics are planned until 2030. So it's likely part of this whole plan. They will always invent a crisis in order to trample on rights and take away freedom. They need it as that cover story to take freedom away from people and get the public to accept it. So we're probably in for 8 more years of health stories very similar to this.
The 2022 federal budget includes the elimination of flow-through shares for oil, gas, and coal exploration after March 31st, 2023. Your thoughts on that?
Well, since the Liberals won in 2015, they've been determined to shut down this entire industry. So obviously a move like that will diminish the attractiveness of investment in the industry, and especially foreign investment, which has fallen off a cliff for the last 7 years. Investors simply aren't going to be able to trust this government to support this sector. And by support, I don't mean with tax dollars. I just mean to get out of the way and just let it thrive would be a start. And they're determined to end this sector in Canada, and it will just simply continue the nightmare for everyone involved in it. Canada could be energy self-sufficient and not an importer of Saudi oil, and the government just simply won't take steps to get that right.
In the 2022 federal budget, there's a push for a central bank digital currency in Canada. Your thoughts on that?
Well, in my opinion, that's probably the scariest part of the whole agenda, because if government can get people to use that, then government can control everything. So just in recent weeks, we've seen a phone app in Sri Lanka that rations petrol. So they have a big supply chain crisis, gasoline's running out, etc., food's running out, so they get everyone to put an app on their phone that allows you to buy a certain number of liters per week, and you can't go beyond that. Sweden just introduced a credit card that turns itself off if you spend too many carbon credits in a certain time period. So that's all giving us a clue of what central bank digital currency will look like. They will attempt to put a control system like this in to control consumption, take away freedom, take away your individual choices, and it has to be stopped.
Well, we saw with people involved in the Freedom Convoy getting their bank accounts frozen. Would this become a common thing for the government to do if they control, like Sweden, turning off your credit card, a way to control your thoughts, your actions, your political affiliations?
No, of course. We've seen complete political persecution with the Tamara Leach story recently. Like no normal citizen would be treated like that based on the charges that she's facing. She's never had a criminal record. And this is the first sign, I said this on Twitter, I think within the last week, is it's the first sign of a totalitarian dictatorship is when government goes after political opponents. And I never, ever thought I would see that in Canada. Clearly there are always going to be people that whatever governments in power are upset at, but I don't think we've ever seen government take action the way they are. And the response with regards to the bank accounts being frozen, the solution to that was everyone head to the bank and withdraw your money, because that'll last about 1 day, which is pretty much what it was, because the system can't withstand that. So that's the solution to that. And that's a great example of the people fighting back. And the banks immediately phoned Ottawa and said, you have to stop this, because there's going to be, in a fractional reserve banking system, it'll put the banks under huge stress. So that was a great example of the public standing up and really helping out with those who had their accounts frozen.
Have you heard of any people thinking of moving out of Canada because they fear the government might take over their bank account because they have said things that aren't favorable to the government? I personally have friends who are doing that.
Yeah, it is a risk. I mean, there was some figure that of the number of people who have left Ontario in the last year, and I think it was something like 60 or 70,000. A lot of people are moving to the red states in the U.S., Florida probably being the top example. But it is truly a global agenda, so I think it's very essential that everyone fight back where they are instead of trying to leave. I don't think there'll be many places to go. It really needs to be stopped in each country. So, yeah, it's absolutely a risk.
Is today's liberal ideology the same as liberal ideology from decades ago?
I think it's radically different. We had recently the Ontario election. The Ontario NDP used to attempt to represent blue-collar workers and union members, and now they're all about the woke agenda and critical race theory. So I think there's been a radical change on the left, and they didn't stand up for anyone who chose not to take the vaccine. And the same situation exists in the United States. If you compare a leader like JFK to the modern Democrats, it's a night and day difference. Today they're obsessed with COVID restrictions that they don't want to let go, and obsessed with controlling people. And they got so used to that over the last 2 years because they were able to that they can't let it go.
Are there any safe places to keep your wealth?
Well, I think in 2022, for the average person who's not looking to, let's say, short stocks, take advantage of falling prices, I think for most people, cash will actually end up being the best option. I don't like any of the asset classes now. I think bonds, stocks and real estate are all in for much more pain. And if this turns out to be true, then you've saved all along, then cash can be used to buy assets at much cheaper prices. So it's a pretty simple solution. It seems like the wrong thing to do because you feel like your money isn't going anywhere, but it's not bet on assets that are falling. So I think it's actually a really good idea.
I know I mentioned people perhaps bailing on Canada and going someplace else. Is there any place else you could go, or would digital currencies just follow you everywhere around the planet?
It's a good question. I mean, it's hard to say what would be safe. I mean, it almost seems like Russia would be the best place to live. Like, I don't think any Canadian would have ever imagined that growing up, right? It's like, but they've got a leader that's really looking out for his own people and absolutely saying no to globalism, and that's why they're so upset at him. And we've had other places like El Salvador, but I think that government in general has done a very good job. And I saw some of their COVID ads when they were simply telling people, they have a little kit to say, just take vitamin D, just take zinc and quercetin, you'll be fine. And so there are places that seem pretty attractive, but every government can of course change, and regime can change, and you could be moving to what seems to be a good situation and then have the rug pulled out. A lot of people think good things about Costa Rica, but I really think the best thing is to solve the problem here.
Now, the people I've been talking to with the Fed hiking rates, real estate on the edge of collapse, yet people are still very employed. There's labor shortages. Have you ever seen an economic situation with so many mixed messages at the same time?
Never. I mean, it's absolutely unprecedented. And some of the labor numbers, as you say, in the States do look very tight. If someone were to look just at that data, they would think everything's great. And but it's just extraordinary. The amount of and the debt that's come in the public and private sectors is just astounding. Like they use COVID as an excuse to do insane amounts of deficit spending that frankly they're nowhere back to even trying to balance. They're not in a position to try to balance budgets. So I think it will end with the bond market simply rejecting all of this. I think government's gotten very used to being able to just issue bonds every week and the auction happens and everything's fine. But I think there'll be a point where the bond market just says no. Like they just won't buy anymore, and government will have to reduce spending at that point.
Ian, how can people follow you on Twitter?
I'm on Twitter under my real name, Ian Prittie, and the handle is the Reds 8, THEREDS 8.
Ian, thank you so much for being on This Week in Money.
Thank you so much. It's been fantastic to be back on. I appreciate it.
My guest has been Ian Prittie. He's an economic analyst. He was speaking to us from Toronto. Find him on Twitter at the Reds 8. Coming up, Wolf Richter next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from beautiful San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf just released the latest GDP figures for the U.S., down again. So under the old definition, maybe the current definition of a recession is 2 quarters of negative GDP. Is the U.S. really in a recession?
Well, the definition of a recession is, as the U.S. government uses it, it's defined by the NBER, which is the National Organization of Economists, and yeah, it is a much broader thing than just 2 quarters in a row of GDP decline. So they call out when it's a recession. And the last recession didn't even last 2 quarters. It lasted less than 1 quarter, the one that started in March 2020. So it doesn't have to be 2 quarters. It could be shorter. But also it's much broader than just the GDP decline. And what they're looking at is other metrics such as the labor market and different things. And that's exactly where it gets really complicated this time, because yes, GDP is down 2 quarters in a row, but it's down for reasons other than the consumer. So the first quarter we had a big decline because of largely driven by a plunge in by a worsening, I should say, of the trade deficit, by a massive worsening of the trade deficit, which is a negative on GDP. And the consumer spending part in the first quarter actually rose 2.8%. So that's adjusted for inflation. That's in the normal range, you know. And still we got this negative rating in Q1, and in Q2, consumer spending adjusted for inflation rose 1%. So that's lower than the average before the pandemic, but it's still positive. So they're still outspending inflation. But we had a huge plunge in private investment, including a massive plunge in investment in housing. And that is a big negative on GDP. And then we had the third quarter in a row of spending declines by state and local governments. And the federal government too, so at all levels, government spending declined. And this is spending this really investment in consumption. So not spending on salaries and transfer payments such as, welfare and social security and unemployment, but investment in consumption. So what the government spends on fuel and office rent and military equipment and those kinds of things. And defense spending went up for the first time in several quarters, but all other spending categories for consumption and investment items fell and fell dramatically in some areas. So these are the two things that forced GDP down. Consumers held up okay-ish, but private investment plunged, and government investment and government consumption dropped too. And so my gut feeling is that this won't be an official recession yet, because they're looking for a widespread declining in economic activity, and the consumer, which is 70% of the economy, is still, consumer spending is still increasing. So my gut feeling is that they will say, no, this is not a recession yet. We need for the consumer spending to go down, and we need the labor market to cool off to where we actually have a decline, a substantial decline in employment, and then probably, and we may get that at some point, and then probably will get that at some point, but I don't think the first 2 quarters qualify for that. And it's really a split thing now, that with interest rates having risen with so much uncertainty, investors really have plunged. You can really tell. I mean, all the companies are cutting back on the investments, not necessarily people, but they're getting rid of offices and warehouses, and they're canceling plans to build stuff, and they're doing those kinds of things. And then there's, the decline in the housing sector, with the home builders having gotten spooked by huge amounts of inventory that we already have and of newly built houses. So it has that kind of direction where government spending goes back to where it was before the pandemic. So after the big binge, it's declining because of that, and that's the third quarter in a row that it declined. And then investment, and that just doesn't really sound like a recession to me. We've still got we've got labor shortages all over the place. There's some companies laying off, but the layoff numbers are really small. They're, in the hundreds, and a couple of thousand a year. Our unemployment claims, so where people apply for unemployment compensation, have ticked up a little bit, but they're still near historic lows. So the labor market, is still very, very strong. We've got all these job openings. Companies still have trouble hiring people. So, it just doesn't seem like this would be an official recession yet. We need to have a broader decline in economic activity, and we need to really see the labor market cooling off some before that will probably be called a recession.
Sure. In the U.S., 11 million job openings for the second straight month. Canada has over 1 million job openings. The Federal Reserve hiked its official rate again this week, this time by 75 basis points. How high could interest rates go, and how long could it take them to get there?
Yeah, so now we're at the upper range of the Fed's target range is 2.5%, and up from 0.25% in February. So this is a pretty good move, over 2 percentage points in 5 months. And the Fed, Powell yesterday at the press conference indicated that if inflation comes in hot again, they might do another 75 basis point hike in September. So that's the next meeting they'll have is in September. And so that will bring the upper end of the range to 3.25%. And then he indicated that would possibly slow down the magnitude of the rate hike, so still hiking, but at smaller increments, so maybe 25 basis points or 50 basis points each time at the remaining 2 meetings. So, that'll get us into the mid to upper 3% range, and we haven't seen that in many years, and they're indicating that they're going to continue hiking next year. They're suggesting, in June they suggested that interest rates might go to 3.5% before they pause. It looks like they're going to blow past that. I mean, every projection they have made has been superseded by much more aggressive hikes. So each time along the way, they say, well, over the next few months, we think we might be there, and then we get there, we're much higher in terms of interest rates and in terms of inflation, in terms of all the other issues we have. So, there are a lot of people that say we need to have at least 4% next year to make any kind of dent in inflation. The government is also doing quantitative tightening, and which has a similar effect to rate hike. So this is on top of the rate hike, and it just started doing that. So we're in the phase-in period. So the amount of asset reductions on its balance sheet are pretty small, still relatively speaking, but they're going to go to full speed in September. So that will have an impact on long-term rates, and my gut feeling is that if they do enough of it with 4% on the short end and then plus quantitative tightening for the longer term rate, that might be enough to bring inflation down. But it might not be. I mean, there's other people that say it's going to take a lot more than that, because inflation has not really gotten entrenched. And everybody has underestimated, so everybody at the Fed and at the government levels have underestimated how inflation would develop. By huge margins. They blew it off. They didn't take it seriously. I've been screaming about it since February last year, and they call it transitory and temporary and just ignored it. And so now it's deeply entrenched in the economy. It's spread across all sectors. It's in services, and services is a big part of the economy, and it's there. And it's much harder to entrench once it gets into services. So it's unrelated to commodities now. So they're going to have a battle on their hands, and they, from the press conference yesterday and prior press conferences, they're not taking it very seriously. They're not brushing it off anymore. They know this is a challenge, and they know it's going to be painful to get this inflation back down, and they will continue hiking rates even if we have a relatively mild recession. We may have one here now or in the future, but if inflation keeps coming in hot, they'll keep hiking. That's the impression I got. And it was a very hawkish press conference yesterday, very very determined, to get on top of this thing. And I think in terms of Powell's case, it's going to be his last government job probably. And he's in private industry. He's at the age where his career is kind of set. And now it's a legacy issue for him. Does he want to be known as the guy that unleashed this monster inflation, the worst we've had in 40 years, and go down in history as that, and as the guy that couldn't get it under control? No, I don't think so. I think he wants to go down in history as the guy that that was able to get this back under control and bring inflation back down to the target of 2%. And you know, I can see that motivation there. You know, the economy needs this inflation to go down. It's terrible. You know, it causes all kinds of issues. The lower income people are just ravaged by this inflation, you know, because what they're buying, inflation is much higher. They're buying necessities, you know, they're spending their money on necessities. They can't get out of those. And inflation is in the double digits in those things. So, you know, inflation has a terrible price, it's a terrible price to pay, and lots of people at the low income, categories are paying that price more than the middle class and wealthy people. And so it needs to be brought under control. And if it takes much higher interest rates than what we envision, you know, I think that's okay. You know, if the Fed has to go to 5 or 6 or 7%, you know, if that's what it takes, it's fine with me. You know, it needs to be brought under control and soon.
Wolf, why aren't we seeing higher rates for things like GICs? The official bank rate's gone up. How come the interest I get on my savings account hasn't gone up? Or if it has, it's 0.00001%.
Well, some banks in the United States, at least, have started raising their interest rates from, like you said, near zero to a little over 1% now. So these are the high yield savings accounts, and there are some out there. Some of them might get close to 2%. We have seen that short-term government bonds are well over 2%, close to 3%. So, people can invest in those. There may be 3-month or 90-day bonds, or bills, you know, that will be a way out. But banks they're flush with money. You know, they don't have to offer competitive interest rates to attract more deposits. So it kind of goes by that. If a bank wants more money and more cash, you know, if it needs to attract more deposits, it will raise its interest rates. But yeah, they're just flush with it right now, and so they're under no pressure to compete for deposits. They will eventually, you know, and some banks might get into that already, but most of the big banks are just flush with cash and don't really have to do that, and are not going to do that because it cuts into the profit margin. So unless the competition forces them to, the interest rates you're getting on your savings accounts are going to be low. Now, if you go shop around, you know, if you go to your brokerage account, they have brokered CDs here in the United States. So these are government insured savings product CDs by different banks, and you can buy them through your brokerage account. So that might be from Wells Fargo or from some other bank, and you can buy them through your brokerage account. They're trying to attract customers that way, or deposits, and those are much higher. Those are already at over 2% in the 6-month range, so, and higher 1 year. So yeah, there are starting to be rate increases out there for savers and for government short-term bill investors. But you know, we've got inflation of 9% here in the United States, and it's close it's in the 8% range in Canada. So you know, you're still getting eaten up by this inflation, and your yield, whatever you're going to invest in, is not nearly enough to compensate you for this inflation.
With rising rates, what's happening to the housing market?
It's cooked. You know, that's right now we're seeing a plunge in volume, and the same in Canada. You know, whole levels of buyers have left the market because they can't afford the payments, and so sellers haven't lowered the prices yet enough to get to where the buyers are and the potential buyers. You know, so there's this kind of freeze going on. You know, where the volume just dies down, and the sellers are refusing to lower their prices by enough, and the buyers, the potential buyers, can't and don't want to come up, and so volume has plunged. We just got the pending sale for California in June. It's down 40%, 40. That's a huge amount. I mean, these transactions have just come to a halt. sellers are cutting their asking prices now in order to move the home, and so there's now widespread price reductions. That still hasn't done a whole lot because the price reductions are still pretty timid. So in the San Francisco Bay Area, in several counties, we now have seen the first year-over-year price declines, still pretty small. On a month-to-month basis, prices have fallen. In terms of new houses that are being sold, prices are down by about 10% over the past 2 months. So home builders, those are the professionals, those are the pros that can read a market. They're cutting prices pretty aggressively now to sell their homes, and we've got we've got 9 months supply of new houses on the market. Now these are houses in all stages of construction, so it's not just finished homes, but all stages of construction, and home builders are selling homes that haven't been built yet, and home builders are selling homes that are under construction. And then if they still haven't sold the home by the time it's finished, they got a finished home in their hand, and then they're going to have to sell that, and they're going to have to get pretty aggressive to sell it. Well, it becomes part of their inventory, and that gets very expensive. So the home builders are starting to move pretty aggressively to get this inventory under control. But private sellers have not done that, and, so we have seen volume just plunge. Same in Canada, prices just kind of edge lower, and that's kind of summarizes the housing market. In some areas, there's less of a problem, and then in other areas, there's much more turmoil in the housing market.
Could stock markets be in for a rally here?
We've got a pretty good summer rally going, and it's been going on for about a month now, and it was kind of expected after the huge sell-off we've had earlier this year, and so we've got the summer rally. It's not super powerful at this point yet, and all the major stock indices are still way down from the peak. And it reminds me during the .com bust when the Nasdaq went down 78% over a 2.5 year period. And during that time, it had a super powerful summer rally went up like 33%, never went to its old high, but had a very powerful summer rally, and then collapsed afterwards, and I just took everybody with them, and people lost lots of money, when we thought that, okay, this rally is going to hold, we're going to go back to where we were, and then it just vanished, and it has a little bit of that feel now that we've got a pretty good summer rally going on here, and then, it looks to me like after it's gone its way, it's going to vanish too.
What are companies going to do with their office space now that working from home is all the rage?
One of the biggest players we have in this, is Amazon, and then we've got the other big ones, Google and Facebook, and these are huge companies with huge offices, and Amazon is building 6 office towers in Seattle area, and it's building a tower in the Nashville, Tennessee area, and it's put construction on hold of these towers, and it just won't even start construction on a 7th tower in the Seattle area. And, it's trying to look at everything and trying to see whether the floor plans are right for working from home. Because people come in, but they don't come in every day, so you got to have a different arrangement. And it's looking at whether it needs as much space or not. And, Facebook and Google both have started putting some of their offices on hold, some of the expansion projects, in smaller companies, Twitter just announced that it would, reduce its office space in San Francisco, and then cancel a deal in Oakland. And You hear this every day now. They're cutting office space. They don't need it. It's empty. It was empty before the pandemic. It's empty now. Before the pandemic, they figured they will grow into it, so they got this office space to grow into. Now they know that they're not going to grow into it because the switch to working from home allows for smaller office space, and they're going to have to rearrange the office footprint. And this is all over the place now. And so the office vacancy rates are already, catastrophic. In San Francisco, it's 27%. In Dallas and Houston, it's over 30%. They're going to go up further. And, super, new, classy office buildings, they're going to find tenants. But, like the stuff Amazon is building, if it wants to lease it out, they're going to have tenants for that because companies will upgrade. They will go from the older buildings to new buildings. But the older buildings will just eventually empty out, and that's what we already see that. We already have a bunch of those buildings around the country. They're essentially empty. The landlords default on the mortgages. Buildings go back to the lenders, which in most cases are commercial mortgage-backed security holders. So these are bond funds and pension funds and et cetera, not banks that own these. And, then the question is what happens to these empty buildings. And, some of them are going to get torn down and others, somebody's going to buy them for, a few cents on the dollar and spend some money on them and maybe convert them into, if it's possible. It's not possible with many office buildings, but it's possible with some office buildings to convert them into residential buildings. Or they'll create some really cheap offices, and make competition on some of the others. And if they have a lower cost basis, they can do that. So the whole commercial real estate sector in the office segment is going through some pretty major rethinking right now, and this will take many, many years to pan out, and it will involve a lot of losses with investors in these mortgage-backed securities and lenders that have the mortgages and landlords, and so this is a slow-moving process, but it's happening, and it's happening building by building.
Is there suddenly an inventory glut at retailers, as we're starting to hear?
Yeah, so there's Walmart and Target have announced that they have some overstocking problem. And it's interesting, Walmart talked about it extensively, and what they're overstocked in is some items, patio furniture, clothing, that kind of stuff, and their sales went up and they're short on some things. The food's doing really well, but they're overstocked on just a few items. And that takes the national press, and so everybody's talking about inventory glut, and, Walmart, cut some prices on apparel to sell it, but overall, when you look at all retailers combined inventories in terms of the inventory to sales ratio, which eliminates the cost increases, the impact of inflation. So in terms of the inventory to sales ratio, inventories are well below the pre-pandemic range. Part of that is driven by the auto dealers where new vehicle inventories are catastrophically low still. There's still shortages, widespread shortages. Used vehicle inventories are fairly tight. And grocery stores have finally been able to stock back up, so they're near normal levels, a little bit below, and that's good because we went through all the empty shelves era, and that was a very scary thing. You walk into a grocery store and the shelves are empty, and it spooked a lot of people. So anyway, the grocery stores were able to get all their supplies and consumables in order, the supply chains in order, so they're now reasonably well stocked, even though they're a little bit below normal levels. The general merchandise stores, so that's Walmart and Target and those companies. They're high a little bit compared to pre-pandemic levels, and because they're over on some of these specific items that people just splurged on during the pandemic and then suddenly stopped buying them, like patio furniture. I mean, the demand just collapsed for this stuff because everybody went out and bought patio furniture during the lockdowns, and then when they were over, people go buy airplane tickets and go travel and fly and stay in hotels, and get rental cars and stop buying patio furniture and other things. So it had that impact that the sales plunged and they were overstocked. And so you see that in general merchandise retailers. Apparel retailers are overall are not overstocked, even though Walmart has this problem and Target has this problem. But the more specialized retailers, they don't appear to have the problem right now. And so it's really a mixed picture. There's only a very small part of the retailers. So general merchandise retailers is about 10% of total retailers in terms of inventory, and they have some problems. But the biggest part, which is auto dealers, that's about a third of total inventories. They're woefully below where they should be, and others are more or less on target.
What's happening with new and used auto sales?
Yeah, we haven't gotten the retail numbers for July yet. So today is July the 28th. We're going to get them in the first few days of August. So the estimates are that sales for new vehicles are about 10% below where they were last year, and for used vehicles are also a little bit below where they were last year. Now, used vehicles, there are no real shortages. The supply is adequate. It's not huge. It's adequate. So dealers don't have a lot of used vehicles. They have enough, but not a lot. So they're not really cutting prices. We had huge price spikes in used vehicles last year. I mean, just gigantic, 40% at one point. And so they have come down a little bit from that, but have now stabilized at very, very high levels. And dealers are reluctant to cut because, there's not a lot of supply on the lot, and they don't really feel like they're having to cut. And consumers are paying those prices, and so we're in that situation. New vehicles are just in short supply, especially more economical vehicles are essentially sold out. Now with the high fuel prices, there started to be some supply of pickup trucks, especially with some brands like Ram and a couple others. But the vehicles that people are now suddenly buying, the mid-sized cars and that kind of stuff that, you can't find them anymore. They're gone, and EVs are really hard to get, and anything that can save people some money in gasoline is hard to get. And automakers across the board are struggling with the supply chain still. I mean, there's still widespread shortages of these special, cheap microprocessors that automakers use for the different components like rearview mirrors and backup cameras and all this stuff, and they can't finish their cars without those, and that is getting better, but it still hasn't been resolved fully. And GM always announces every quarter how many unfinished vehicles they have sitting on the lot that are missing a component that they're waiting for, and it's close to 100,000. And that it's just still screwed up, and eventually they will figure this out. Eventually there will be enough supply of these components, and they can build enough vehicles to meet demand, but that's just not the case right now. And so prices in new vehicles remain sky high. The automakers have cut incentives to record lows, essentially zero, close to zero for leases, and to very low rates for regular purchases. And dealers are still pricing new vehicles above sticker. You still have that going on, because there's just no supply, and there's still enough demand to sell whatever automakers are able to build, and that's the situation. And we're every year that this is going on, we're building 2 or 3 million vehicles less than normal demand might be. So this is cumulative. So at some point, this forms pent-up demand. And, there are people out there who would like to buy a new vehicle, who've been wanting to buy a new vehicle for a year or two, and who can't because it's too expensive right now or too hard to get, and they just say, forget it. I don't want to order and then wait 6 months or 8 months to get it. And so you have this backlog out there, and a huge order bank. Every automaker has huge order banks. They've stopped taking orders for a lot of models already, and you wait till next year kind of thing. And So this is built up, this pent-up demand we've got here. So even if you get a recession, if consumer demand declines, if supply rises, there are still people out there who want to buy and who couldn't get it and who then will be able to get a vehicle. So, I've never seen a market that is this screwed up. It is just, and it's supposed to be resolved last year. It's not resolved now. It's July now. It's not going to be resolved by the end of this year. Maybe it will be resolved next year. It just keeps dragging out.
Wolf, with the high price of electric vehicles, if you can lay your hands on it, has the price of gasoline gone high enough that you actually save money by spending that really high initial cost?
Well, you could. That's been the case for a while. EVs are a lot cheaper to operate, and they're more expensive. They're not much more expensive, really, than a gasoline vehicle. The average transaction price for ICE vehicles, for gasoline vehicles, is something like $48,000. And you can get nice EVs for that amount of money. So if you buy a luxury EV, it's going to cost you more. Tesla is considered luxury or near luxury, depending on what model you buy. You're going to pay more. But if you buy a standard EV, they're cheaper than that, and they're now available, and they are below the average transaction price in the United States. And so it's not they're not that much more expensive anymore. And every single EV that's being built is really nicely equipped. I mean, these are not economy cars in the sense of econo boxes. These are really nice vehicles, and so that's always been the case. But now gasoline prices have come down. I mean, there's been a lot of demand destruction in the last month or two because of these high gasoline prices. So gasoline prices have come down a lot. But even then, it makes a lot of sense to buy, spend a little extra money for an EV or for a hybrid. I mean, if you get 50 miles a gallon with the hybrid, you spend $2,000 more to get that. That can save you some money, and that could be a hybrid pickup truck. They have those now. They save quite a bit of money on gas. And so high gas prices change the calculus of how you look at acquisition costs. And it's across the board. It's not just EVs, it's gasoline vehicles like pickup trucks, and they get not a great gas mileage in the normal versions, but Ford makes a hybrid, and it's pretty good. So it's a calculus that a lot of people are making, and electricity prices have gone up too, but an EV uses relatively small amounts of electricity. It's not a big thing, so definitely the calculus makes a lot of sense, and a lot of people are trying to do it.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ian Prittie, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@HowStreet.com. Now stand by for a company showcase update from American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the CTO of American Manganese. Zarko, welcome back to the show.
Thank you, Jim.
Zarko, what's new there in what's perhaps one of the busiest offices in Western Canada?
Well, actually, we did announce that I was doing that UBS call, the Energy Transitions Call series, and we had received the recording, and we put that out on our social media and mailing list for everybody to listen to and follow along. So I do encourage everybody to listen to it. It was well received. The recording is there. You can also follow along on the updated company presentation as I go through it, and as well as answer the questions that came in during the event. And I just want to remind people as well, these are kind of the more direct marketing efforts we're making, and getting involved in, being up front and center, and really going into the details of explaining our process and where the value proposition is. And then just kind of, switching over, I know we also did a quick company update on our demonstration plan. That was just a quick update video, and, that received more mixed reviews. But I just want to say, we do stand by our company's belief of complete transparency. And in that effort, I will admit in the video that we could have provided more explanation of what was going on. I think in the moment as the demonstration plant is working, we can kind of work with a camera. It's not ideal to be working with a full camera crew and getting into the operators' faces as everybody's working day and night shift and really trying to focus on the task at hand. So really this is just trying to sneak in videos as things are operating, as, things are moving around, just to give the public a perception of really what is going on, right? Like when you see equipment like this, it's not, it's not polished, it's not clean, and that really should be your first sign to see that there is real work happening, and that this demonstration plant project is moving forward. But to add more context to what that video was, is really you're looking at what we would call the pre-leach stage of our flow sheet, and really that's where we'll put in the cathode scrap materials that come from the battery production. So those are the off-spec materials that come from battery production. And really the first task in that stage is to separate the active materials, so like your lithium, nickel, manganese, and cobalt, from that aluminum electrode that it's coated onto. And then from that step, we go over to the next stages, which are the leaching, and there, we'll be doing, testing, and there we can report on like things like leach extraction efficiencies as we collect that data. So there we'll be looking at our proprietary process where we're extracting the lithium, nickel, manganese, and cobalt that was just separated from the aluminum electrode. And then once, going further into these stages and then completing this whole loop of the demonstration plan is, once with that leach solution, we would remove any impurities that happen to be also leached into solution, and then from there move over into the precipitation of the nickel, manganese, and cobalt, and then further to that, the removal of and extraction of lithium. So these are all kind of milestones I think listeners can really think about as we move through, and there is always a learning aspect to these things, and then a demonstration plan scale, we want to make sure, doing it at this scale is a learning curve, but it's also manageable versus going directly into commercial scale. So that's just kind of an update. We'll try and provide more of these more descriptive updates, videos, just to really see in its raw form how this process works. So I'll leave it out, demo plan updates, and I'm happy to hear anybody's feedback or kind of what else you would like to see. Also keeping in mind, we do have to keep other things proprietary and not share as freely, but we are as transparent as we can be.
Well, Zarko, the way I'd like to compare it is the Wright brothers flyer barely staggered into the air. Now we have F-22 stealth fighters. what you're looking at right now with your demonstration pilot plant is the Wright Flyer. Yes, we're making sure that it can get up in the sky, but you plan to build the F-22, right?
Yeah, that's a good way to put it, right? These are the stages you have to go through. I mean, there's not, like I said, again, polished floors, clean tanks. Like, this is work being done. This is, customizing pieces that we, as we learn and find, okay, we're going to need to fit this in or makeshift something, right? So but when it comes to that commercial design, all of that data and all of that learning really comes together, and just exactly like you said. I just want to finish off kind of and just talk about how busy our team has been throughout this summer. I know, you kind of just hear from myself, Shaheem, Larry, as speaking to the listeners. But, our advisory group, our directors, everybody's really active in the company. I just also want to mention with Johan Rudat in Europe. He's on their advisory board. I'm sure many listeners are familiar with him as well, and he's really actively working and just continues to connect us to many opportunities. So, there's a lot going on, a lot of work happening in the background, and, I'm really excited. I'm really excited with everything, and, I think we're all looking forward to the long weekend here in Canada, so just thought I'd keep this podcast short. Wish everybody a happy long weekend, and looking forward to more company updates.
Zarko, for people new to American Manganese, soon to be Recyclico, what does the company do? How can they get more information about it, and where are you traded?
Yeah, we're a critical metals company focused on the lithium-ion battery recycling and upcycling. So we do extract up to 100% of the lithium, nickel, manganese, and cobalt in battery waste. You can find more information on our website, www.americanmanganeseinc.com or www.recyclico.com. We're traded on the TSXV under the symbol AMY. We're traded under the OTCQB under the symbol AMYZF, and the Frankfurt Stock Exchange under 2AM. Feel free to give us a call at the office at 778-574-4444, or my email is a long email, but it is on the website, and you can find it there, so feel free to send me an email and ask any questions.
Zarko, thank you so much for the update.
Thank you, Jim.
My guest has been Zarko Meseldzija. He's the Chief Technical Officer for American Manganese, soon to be Recyclico. I'm Jim Goddard. Our conversation took place on July 29th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.